The Federal Reserve's newly confirmed chairman delivered a single sentence in his confirmation hearing that almost no one noticed. That sentence just activated a 72-hour sequence most Americans will never see coming. I'm going to show you exactly what he said, why it matters, and why the clock is already running. The sentence was buried in a routine exchange about balance sheet policy. When pressed on future normalization steps, he replied, verbatim, "We remain prepared to adjust reserve remuneration parameters as evolving conditions require." To 99% of viewers, that sounded like meaningless central bank jargon. To the handful of us who track these signals daily, it was the quiet detonation of a structural shift that has been building for months. For decades, the dominant narrative has been that the Federal Reserve exists primarily to stabilize employment and protect the purchasing power of the dollar for ordinary citizens. That story held together during the low-inflation, falling-rate regime that began in the 1980s. But every major turning point, the 1971 closure of the gold window, the 2008 financial crisis, the 2020 pandemic response, exposed the same underlying order of priorities. Policy first stabilizes the banking and financial system itself. Second, it protects the leveraged constituencies embedded within that system. Only afterward, if conditions allow, does it consider the broader public. This is not malice. It is the logical consequence of a mandate that must preserve the integrity of the payment and credit system above all else. When reserves are abundant and rates are falling, everyone benefits. When liquidity tightens and rates rise, the sequence of protection reverses, and the public is always last in line. Here's the core mechanism explained plainly. Commercial banks hold reserves at the Federal Reserve. Those reserves are the base layer of the entire monetary system. The Fed can influence bank behavior by changing three main levers on those reserves: the interest rate it pays on them, the minimum amount banks are required to hold, and the types of collateral eligible to count as reserves. When the Fed reduces the interest rate paid on excess reserves, sometimes called IOER or IORR, banks immediately face a penalty for sitting on cash. They must choose between earning less on safe reserves or moving capital into higher-yielding assets like loans or securities. Either choice reduces excess liquidity in the system. One small adjustment to that single rate can trigger trillions of dollars in repositioning across global funding markets within days. That is the quiet lever the chairman just signaled he is prepared to pull. Let us examine the precise trigger. During the confirmation hearing, when directly questioned on the timeline for further balance sheet normalization, the new chairman responded with one carefully chosen sentence: "We stand ready to adjust reserve remuneration frameworks as conditions warrant." That is not routine language. It is deliberate Fed speak for signaling an imminent reduction in the interest rate paid on excess reserves, currently the primary tool keeping trillions of dollars parked safely at the Federal Reserve. Reducing that rate, even by 25 or 50 basis points, immediately makes holding excess reserves less attractive to banks. The last time the Fed executed a similar adjustment, in late 2018, repo markets seized within weeks. This time, the starting stock of excess reserves is far larger, and the leverage embedded in the system is significantly higher. The signal has been given. The adjustment is now a question of when, not if. Banks now confront a dilemma with no attractive exit. Option 1. Maintain current excess reserve holdings and accept a lower yield from the Fed. That directly compresses net interest margins at a moment when many institutions are already operating near regulatory minimums. Option 2. Deploy those reserves into the real economy or capital markets, extending new loans, purchasing securities, or chasing yield in risk assets. Both paths achieve the same structural outcome: a reduction in system-wide liquidity. Money that was previously content to sit idle now must move. And when trillions begin moving at once, Frictions appear rapidly in the shortest duration funding markets first. There is no third option. The Fed has removed the neutral setting. The cascade unfolds in a predictable sequence. First, the reduction in interest on excess reserves prompts large banks to withdraw liquidity from the Federal Reserve's balance sheet. Overnight reverse repo facility volumes, which recently hovered near record highs, begin to decline sharply. Second, as reserves leave the system, short-term funding rates begin to rise above the Fed's target range. Repo rates spike, SOFR climbs, and the cost of overnight collateral increases. Third, higher funding costs trigger margin calls on leveraged positions across hedge funds, REITs, and carry trades that have been financed at near-zero real rates. Fourth, to meet those margin calls, institutions are forced to sell liquid assets, primarily U.S. Treasuries and agency mortgage-backed securities. Fifth, forced selling pushes bond prices lower and yields higher across the curve. The 10-year Treasury yield, which has been anchored by excess liquidity, reprices upward rapidly. Sixth, higher yields transmit directly into borrowing costs. Mortgage rates reset higher within weeks. Corporate bond spreads widen, and consumer credit tightens. Economic activity contracts as the cost of capital rises across every sector simultaneously. The mechanism is mechanical, not sentimental. Once this sequence begins, even the Federal Reserve itself loses precise control. The transmission channels overshoot, just as they did during the 2018 Volmageddon episode and the 2022 rate hike cycle. Markets front-run policy, amplifying the tightening beyond what any single rate decision intended. The difference today is scale. The Fed's balance sheet remains more than double its pre-2020 size. Private sector leverage is higher, and political tolerance for aggressive intervention is lower. The Fed can pause or delay, but reversing the move would require reinflating the same liquidity bubble it is now attempting to normalize. That option carries its own risks, chief among them a further erosion of confidence in the dollar's long-term purchasing power. Many assets currently classified as safe or cash equivalent are priced under the assumption of permanent excess reserves. U.S. Treasuries, money market funds, even insured bank deposits, all depend on a backdrop of abundant central bank liquidity to maintain their perceived stability. When that backdrop is removed, true price discovery returns. A Treasury bill is only as liquid as the bidder of last resort allows it to be. When primary dealers are absorbing forced sales from leveraged players, bid-ask spreads widen and settlement fails rise. What functioned as near money yesterday can become temporarily illiquid tomorrow. This is not a prediction of default. It is a reminder of hierarchy. All financial claims are contingent in a liquidity-constrained regime. The arithmetic of the shift is impartial. Those holding unencumbered real assets, commodities, productive land, operating businesses with pricing power, preserve or increase real purchasing power as financial asset prices reprice. Those with long-duration financial claims, fixed-rate bonds, growth equities priced for perpetuity, or leveraged real estate experience the largest real losses as discount rates rise. Creditors with fixed income streams lose to debtors who can refinance or inflate away obligations. This is not ideology or malice. It is the mechanical outcome of a regime moving from financial asset inflation to selective real asset revaluation. Observable actions already confirm the interpretation. Recent 13F filings show several large macro funds rotating heavily into short-duration T-bills and physical commodity exposure while reducing duration in credit portfolios. Corporate insider selling has accelerated, and scheduled share buyback programs have been quietly paused or reduced at multiple S&P 500 constituents. Treasury holdings among known billionaire family offices have shifted markedly toward the front end of the curve. These are not random. Institutional actors who maintain dedicated Fed watching teams are positioning defensively before the public narrative shifts. The playbook that governed wealth accumulation for the past 15 years, buy the dip, maintain 60-40 allocations, trust that diversification and time and market would compound favorably, was constructed entirely within a falling rate, excess liquidity regime. That regime ended with the chairman's sentence. Strategies optimized for perpetual quantitative easing and zero interest rate policy now carry asymmetric downside. The rules have changed. Adapting to the new constraints early is the difference between preservation and unnecessary loss. This shift does not remain confined to trading desks or institutional balance sheets. It reaches directly into daily life. Within weeks, higher short-term funding costs transmit into the mortgage market. 30-year fixed rates, already elevated, reset higher as originators widen spreads to protect margins. Home buyers face reduced borrowing power. Refinancing activity collapses. Credit card issuers and auto lenders follow within 1 to 2 billing cycles, raising APRs and tightening approval standards. Consumers carrying revolving balances see interest expenses compound faster. By the second quarter, corporate borrowing costs constrain capital expenditure and payroll growth. Hiring slows, particularly in interest-sensitive sectors: construction, real estate services, technology scale-ups. Unemployment claims begin a steady upward drift. Your personal cost of capital has already increased, even if the effects are not yet visible in your statements. The transmission lag is measured in weeks and months, not years. The most concerning feature of this regime shift is its self-reinforcing nature. Rising yields reduce the market value of existing collateral: treasuries, mortgage-backed securities, corporate bonds. Lower collateral values trigger additional margin requirements on leveraged positions. To meet those requirements, more assets must be sold, pushing yields still higher and collateral values still lower. Each iteration validates the previous one, creating a feedback loop the Fed can interrupt only by reintroducing the liquidity it is simultaneously attempting to withdraw. The central bank faces a narrow window. Act too slowly and the loop accelerates. Act too aggressively and it risks reigniting inflationary pressures or undermining confidence in its normalization commitment. Historical episodes, most recently the 2022 bond market rout, show these loops tend to overshoot before policy response catches up. The current starting point offers less room for error than any prior cycle. In 1971, an overlooked statement about temporary suspension of dollar-gold convertibility preceded rapid dollar devaluation and commodity repricing. In 2008, the decision to let Lehman fail, after repeated assurances that no systemically important institution would be allowed to collapse, triggered a global funding freeze within days. In 2022, the Bank of England's brief pause in gilt sales exposed the fragility of liability-driven investment strategies across UK pension funds, forcing an emergency reversal. Each episode began with a policy signal dismissed as routine, followed by initial market denial, then accelerated repricing across asset classes once the mechanical implications became undeniable. The current signal follows the identical script: a carefully worded commitment to normalization that markets must now price as credible. We are crossing from a regime defined by excess liquidity and falling real rates to one defined by liquidity constraint and rising real rates. The behavioral rules that govern the past 15 years — leverage aggressively, extend duration, trust central bank puts — no longer apply without severe qualification. Wealth creation strategies must now prioritize resilience over yield maximization, shorter duration, higher convexity, greater emphasis on cash flow generation over multiple expansion. The psychological adjustment is significant. Market participants conditioned by perpetual accommodation will resist the new constraints until forced to adapt by price action itself. Recognition of the shift provides a material advantage. Those who adjust early, before forced selling dominates price discovery, can reposition portfolios with minimal slippage. The window is not infinite. Once repo stress becomes visible in headline rates and media commentary, the crowd will move simultaneously, compressing optionality. This is not about timing the exact bottom or top. It is about aligning with the structural direction of travel while others remain anchored to the expired regime. Early adaptation has preserved capital across every prior shift. The same opportunity exists now for those willing to act on the signal rather than wait for confirmation from consensus. There are three structural moves that have consistently preserved wealth across every major regime shift of the modern era. The first is a deliberate shortening of duration across fixed income exposure, moving out of long-dated bonds and into instruments that reprice quickly to rising rates. This reduces the embedded interest rate risk that punishes holders when discount rates reset higher. The second is a selective rotation into real assets with intrinsic cash flow generation and limited financial leverage, assets whose value is tied to tangible productivity rather than multiple expansion financed by cheap debt. The third is maintaining elevated dry powder positioning in true liquidity, short-duration claims that do not depend on continuous central bank accommodation for their stability. These are not speculative trades. They are defensive alignments rooted in the mechanics we have just walked through. I have implemented all three personally and have documented the specific asset classes, allocation ranges, and sequencing considerations in a detailed guide I have only shared with my private list until now. The guide includes precise examples, tax implications, and implementation steps that do not require perfect market timing, only recognition of the regime change we are now entering. It is available for immediate download at the link below. The 72-hour sequence referenced at the beginning is not hyperbole. It is the typical window between a clear policy signal and the first visible stress in overnight funding markets. Once those stresses appear in headline data, SOFR fixings above target, reverse repo volumes dropping sharply, the broader market will begin to price the new regime simultaneously. That convergence compresses the window for deliberate repositioning. I will post the next update the moment new primary data confirms the Cascade has entered its active phase. This is not about fear. It is about clarity. Those who act on structural signals early preserve optionality. Stay sharp. I'll see you in the next update.